Welcome to this deep dive. You know, it's kind of funny. Sometimes ideas you just brush off.
hmm
They come back years later and really hit you.
Happens all the time.
Yeah, like 20 years ago, college kid me,
Yeah.
I picked up Robert Kiyosaki's Rich Dad, Poor Dad. Skimmed it, probably, scoffed a little.
Uh-huh.
Thought, oh, just another motivational book. Filed it away. Man, did I miss the point back then.
Well, you're not alone there. Those financial ideas often hit differently once you've got some real life under your belt.
Totally. Fast forward 2 decades, and my whole view on his message completely flipped. Turns out there was some, like, serious wisdom there. I was just too young, too naive, maybe, to get.
It's a common journey. Experience makes those concepts resonate.
Exactly.
Yeah.
Back then, make your money work for you, focusing on assets.
Mm,
It just didn't click. My head was all, get a good job, climb the ladder, the usual advice.
a safe path, supposedly.
Right. And I did that for 20 years. Worked hard, got promoted, thought I was doing everything right. But, like Kiyosaki warns, just being a good employee, it can leave you blind if you're not building your own financial foundation too.
That regular paycheck feels secure, sure, but it can kind of keep you in a box, away from really building wealth through assets.
Absolutely. And then came my wake-up call. A pretty painful one, actually, a few years back.
Oh.
Yeah, I decided, okay, time to get into the stock market. Thought it was the fast lane,
Uh-oh. Famous last words sometimes.
Tell me about it. My approach was, well, not exactly strategic. I threw $1,000 into Bitcoin. Why? Just because it was all over the news. Pure FOMO.
The fear of missing out. Yeah, that drives a lot of early investment decisions, unfortunately. More hype than homework.
You got it. And guess what? It actually doubled within a year.
Wow, okay.
Yeah. Thought I was some kind of genius, right?
Oh.
Instant overconfidence.
Yeah, easy to do.
So instead of being smart, reinvesting, diversifying,
Hmm.
anything smart, I immediately bought a fancy gaming laptop.
Spent the profits.
Yep. Huge mischance. But wait, it gets worse.
Oh, no.
Riding that lucky wave, I picked 4 other stocks. My research method. Literally just what felt right.
Gut feeling investing? Risky.
You can guess what happened. Within a year, boom, down over 70%.
Ouch.
Yeah, brutal. But honestly, a necessary lesson. Luck isn't skill.
Those hard knocks often teach the most, don't they? Forces you to shift from just gambling to actually strategizing.
Couldn't agree more. That financial gut punch finally got me serious. I went back to Kiyosaki, but this time I grabbed Rich Dad's Guide to Investing. And my mindset was totally different. I was ready to actually learn.
Okay, so a fresh start.
Exactly. And that's what we're really digging into today, those 5 types of investors Kiyosaki talks about. Understanding these isn't just about labels. It's about seeing where you might be right now and, crucially, how you can level up, get more financial control, maybe get better returns.
It's a really useful framework Kiyosaki provides. Good for self-assessment, understanding the different levels of, knowledge and control out there.
Precisely. And to really get these 5 types, it helps to first know what Kiyosaki calls the 10 controls that successful investors should have.
Right, the levers you can pull.
Yeah, think of them like that. They cover everything from the basics, like controlling yourself, your spending habits, your income versus expenses,
Foundational stuff.
to more advanced things, like controlling how your investments are managed, understanding taxes, timing your buys and sells, even getting access to the right info, and eventually giving back.
Philanthropy, yeah.
Right. And as we go through each investor type, you'll see how having these controls, or not having them, really impacts their potential.
Makes sense. More control usually means more influence over where you end up financially.
So let's jump in. First up, the accredited investor. You hear this term thrown around.
Yeah, it's an official SEC definition.
Right, the Securities and Exchange Commission. It's based purely on money. Either you make $200,000 a year solo, or $300,000 as a couple, or you have a net worth over $1 million.
Not counting your primary home, usually.
Good point. And interestingly, what is it? Only about 10, maybe 12% of people in the U.S. actually qualify.
Right. And qualifying mainly just unlocks access to certain types of investments, often riskier ones, that aren't available to everyone else. Less regulatory oversight sometimes.
Exactly. But here's the thing I realized, and it's key. Just having the money doesn't automatically make you a good investor.
Crucial distinction.
You can hit those income or net worth numbers, but still have basically zero grasp on those 10 controls we mentioned. That's why you hear stories, right? Wealthy people making terrible investment choices, losing big. Access isn't expertise.
Absolutely. The ability to participate doesn't mean you have the skill to evaluate or manage that investment well.
So for you listening, maybe you're aiming for that accredited status. The real takeaway here is focus on building your financial smarts now.
Mm-hmm. The education part.
Yeah, read the books, maybe look into seminars, start making small research investments in regular stocks, build the knowledge while you build the net worth. It's not just about getting the money, it's knowing what to do with it.
That foundation is critical at every level, but even more so when you can access those more complex, maybe riskier things.
Okay, moving up a level, we get to the qualified investor. Now, this person has actually developed some solid understanding. They get both fundamental and technical analysis.
Two key approaches to looking at investments.
Right. Fundamental analysis that's looking deep into a company. Their financials, management quality, industry position, growth potential, trying to figure out its real intrinsic value. Is the stock cheap or expensive?
I think Warren Buffett, he's the classic fundamental value guy, looking at the business itself.
Exactly. Then you've got technical analysis. That's totally different. It's all about looking at past market data price charts, trading volume.
Patterns, trends.
Yeah, trying to spot patterns that might predict future price moves. These guys use charts, indicators. Now, sometimes they care less about the company's actual business.
It's more about market psychology, spotting those repeatable trading patterns.
And Kiyosaki's point is, a real qualified investor, they get both. They understand the company's value, but they also watch what the market's doing.
A blend of both worlds.
Right. And these investors, they've usually got a handle on themselves financially. They control their spending, manage their assets versus liabilities, and they're better at timing their buying and selling. They're making decisions based on research, not just hype.
That's a big step up in terms of analytical skill and making reasoned choices.
Thinking back to my early stock fumbles, man, night and day difference. I knew zero about either analysis. My research was headlines and hunches.
We've all been there to some extent.
So, if you're aiming to be a qualified investor, the actionable step, start learning the basics, both fundamental and technical. Pick a couple of companies you like, try analyzing their numbers. It's usually public info. Look at their stock charts.
And maybe try paper trading first.
Great idea. Paper trading using fake money in a simulator. Practice applying what you learn without risking real cash. It builds confidence.
Definitely a safe way to test strategies.
Okay, next level. The sophisticated investor. This person has all the qualified investor skills, but they've added another layer of control. Kiyosaki calls it control over ETC.
ETC. Entity, timing, and characteristics.
Exactly. So what's that mean? Entity is about understanding business structures, LLCs, S-corps, C-corps, and how using the right one affects your investments and, importantly, your taxes.
Legal structures, tax implications.
Timing is about being strategic with when you invest or realize gains, again, often for tax benefits. And characteristics means understanding different types of income, like earned income, passive income, portfolio income, and how they're taxed differently.
So the sophisticated investor is thinking much bigger picture, beyond just the single investment, looking at the whole legal and tax setup.
You got it. Kiyosaki also mentions the 3 E's for these folks. Education, they never stop learning. Experience, they've got real-world, hands-on knowledge from actually doing it, and excessive cash flow, having capital ready to jump on opportunities.
That combination signifies a really high level of financial intelligence.
It really does. It's integrating investment strategy with solid business sense, tax knowledge, the whole package.
A level to aspire to, for sure.
For me, this was the point where I really started to get why understanding business structures and taxes is so critical. It's not just about the profit you make.
It's about how much you keep. Taxes make a huge difference.
Huge. So if you want to move towards becoming more sophisticated, start learning about those different business entities. Look into basic tax strategies for investors. Maybe talk to a financial advisor or a CPA.
Getting expert advice in those areas can pay off big time down the road.
Definitely. Okay, now we get to the inside investor. This is usually your entrepreneur, your business owner, someone who's not just buying pieces of businesses. They're actively building and running their own.
They're on the inside, hence the name.
Right. And that gives them a massive advantage. They have way more insight and control because they're directly responsible for creating and managing the asset, the business itself.
A much deeper understanding than an outside investor could ever have.
Totally. And Kiyosaki says these inside investors, they often have all 10 of those controls we talked about earlier. They control the income, the expenses, the management, the strategy, everything.
Which naturally leads to better potential for success and managing risk, right? If you're steering the ship, you can avoid the rocks.
Exactly. And Kiyosaki points out lots of the wealthiest people in this category. Even Buffett through Berkshire Hathaway, he's essentially running a massive collection of businesses he controls.
That direct involvement is key. You can directly influence the outcome.
Looking back at my own path, spending 20 years mostly as an employee, now feels like I missed a chance to build my own thing, even something small on the side. That experience of creating value yourself, you just can't learn that from a job description.
It teaches you how wealth is really generated.
So for everyone listening, even if you love your job, think about starting something small, a side business, an online project. The goal isn't instant millions, it's developing that owner mindset, understanding cash flow firsthand, learning to create value people will pay for. Those skills help everywhere.
That entrepreneurial thinking really does change how you see everything, including other investments.
Okay, finally, the top tier, the ultimate investor.
The peak of the mountain, according to Kiyosaki.
Yeah, these are inside investors whose businesses become so successful, so big, that they can take them public. Go IPO.
Listing on a stock exchange?
Right. That lets them raise huge amounts of capital for more growth, and it also gives the founders, the early investors, a way to cash out some of their ownership, potentially becoming very wealthy.
It's a massive milestone, signifies huge success, market validation, access to public money.
Hitting this level, it's the dream for a lot of entrepreneurs. It's not just the money, it's building something with a real, lasting impact. Now, for most of us, becoming an ultimate investor seems pretty far off, maybe.
A very long-term goal, yeah.
But it's still useful to think big.
Mm-hmm.
Set ambitious goals for whatever you're building, your investments. Study the people who did take their companies public. Every big success started somewhere, right?
Keeps you focused on the long game, encourages thinking bigger.
So if you're listening and maybe feeling a bit, overwhelmed, thinking, where do I even start? I don't have the education, the experience, the cash.
Which is where most people begin.
Exactly. Kiyosaki's core advice is clear. Start by becoming an inside investor. Build your own business.
Even a small one.
Even a small one. He argues it's the most direct way to gain all 10 of those controls and develop the 3 E's, the education, the experience, and eventually the excessive cash flow all at the same time.
Learning by doing.
And like we said, it doesn't have to be some huge, scary thing. A side project, something online, just something to get you thinking and acting like an owner, even part-time. I admit it took me way too long to really get this advice. But hey, better late than never, right?
Absolutely never too late. That hands-on building experience teaches you things you just can't get from a book.
Okay, so as we wrap up this deep dive into Kiyosaki's 5 investor types, let's just quickly hit the main takeaways.
Good idea.
First, learning never stops. Got to keep educating yourself no matter where you are now. Second, start small, but think big. Have those long-term goals.
Keep the vision.
Third, seriously, think about starting some kind of business, even tiny. It's such a powerful way to gain control and understanding.
The inside investor path.
Fourth, learn from everything. Your wins, sure, but maybe especially your losses and mistakes.
They're often the best teachers.
And last, truly, it is never too late to start taking control of your financial future. Everyone starts somewhere.
It's a process, a journey. And knowing these types gives you a kind of map for that journey.
Well said. And maybe a final thought for you to chew on. What's your very next step? Right now, on your own investing journey, are you actually ready to level up your knowledge, your skills?
Good question to ask yourself.
Yeah, take a minute. Think honestly about where you fit in those 5 types right now and where you really want to be. And hey, if you're looking for more content like this, resources to help you along, I'd encourage you to check out BullishBooks.com.
Lots of good stuff there.
That's BullishBooks.com. It really is time for you to take more control of your financial future.